DS Automobiles enters the period leading into 2026, carrying an identity crisis that has evolved into a financial and structural burden. Conceived as a premium French alternative to established German luxury brands, DS Automobiles was meant to combine avant-garde design with national heritage and modern technology. Instead, it now stands as a brand whose ambitions have consistently outpaced its economic foundation. What remains is a fragile operation struggling to justify its cost, relevance, and future inside an industry that is becoming less tolerant of prolonged underperformance. The most damaging issue facing DS Automobiles is scale. Luxury manufacturing demands either strong pricing power or sufficient volume to absorb massive development and compliance costs. DS has neither. Global sales volumes remain low and uneven across regions, making it difficult to spread fixed costs effectively. Engineering, safety regulation, emissions compliance, and software integration impose expenses that do not shrink simply because fewer vehicles are sold. As a result, each unit carries an outsized cost burden that undermines profitability. This structural weakness feeds directly into ongoing cash consumption and internal debt pressure. DS Automobiles does not operate as a standalone financial entity, but its losses flow upward into group-level capital allocation decisions. Each year of weak returns forces the brand to compete for funding against stronger and more strategically important divisions. In that context, DS Automobiles increasingly appears as a discretionary project rather than a core profit generator. Product strategy has failed to resolve this imbalance. DS models are often praised for interior styling and comfort, yet they struggle to differentiate meaningfully on technology, performance, or brand prestige. In the luxury segment, aesthetics alone rarely sustain pricing power. Without a clear technological or emotional edge, DS relies heavily on incentives to maintain sales momentum. Incentives protect volume, but erode margin and residual value, reinforcing a cycle of weak financial performance. The electric transition intensifies the risk. Moving toward electrification requires enormous upfront investment in platforms, batteries, and software ecosystems. For a low-volume luxury brand, the economics are particularly harsh. Cost absorption is limited, and competition is fierce. DS electric offerings enter a market crowded with better-known brands that already enjoy scale advantages and stronger consumer trust. Price pressure in this environment is relentless, leaving little room for error. Dealer network strain reflects these realities. In many markets, DS operates through shared or closely aligned retail structures rather than robust standalone networks. Low throughput reduces dealer profitability and limits willingness to invest in premium facilities and customer experience. Luxury buyers expect exclusivity, consistency, and attention. When retail execution falls short, brand credibility suffers immediately. Residual values offer another clear signal of market skepticism. DS vehicles often depreciate faster than established luxury rivals. Weak residuals increase leasing costs and require manufacturer subsidies to remain competitive. These subsidies represent real cash outflows that accumulate quietly over time. While buyers may enjoy attractive monthly payments, the underlying economics deteriorate further. Morale is another hidden casualty. Teams working under constant pressure to justify investment and meet shifting strategic goals struggle to maintain momentum. Suppliers face uncertain volume forecasts and tight cost controls, making them less inclined to prioritize DS projects. This reduces innovation input and increases execution risk. Over time, the brand falls behind not because of lack of vision, but because of insufficient sustained commitment. Brand positioning remains ambiguous. DS Automobiles attempts to balance avant-garde design, French luxury heritage, and modern electrification, yet it lacks a singular defining attribute that resonates globally. Strong luxury brands communicate a clear promise and deliver it consistently. DS messaging often feels fragmented, shifting emphasis as strategies change. Consumers respond poorly to inconsistency. Debt pressure at the broader corporate level sharpens the threat. Capital is finite and increasingly scrutinized. Brands that fail to demonstrate a credible path to profitability or strategic necessity face difficult questions. dsautomobiles' survival depends on continued willingness to subsidize losses in hopes of future relevance. That willingness is not guaranteed in a tightening financial environment. The most likely scenario is not a sudden shutdown, but gradual contraction. Model updates slow, market presence narrows, investment becomes selective. Over time, the brand risks fading into niche status with limited reach and influence. Collapse in this sense is quiet and incremental rather than dramatic, yet its outcome is the same. Please subscribe to our channel. We want to hit 1,000 subscribers this week. For consumers, the challenges surrounding dsautomobiles translate into practical ownership risks that deserve careful consideration. Buying a vehicle is a multi-year commitment that depends on the manufacturer's ability to provide consistent support, stable resale value, and confidence that the brand will remain engaged throughout the vehicle lifecycle. When a brand operates under prolonged financial strain, those assumptions weaken. Warranty coverage exists, but experience matters more than written terms. Brands under cost pressure often tighten internal processes gradually. Approval timelines may extend. Goodwill repairs may become less common. Disputes may increase. These changes are subtle but cumulative, shaping ownership satisfaction long after purchase. Parts availability is another concern. Low production volumes reduce economies of scale in manufacturing and inventory. Unique components may be produced in smaller batches, increasing wait times and cost. Owners outside major markets may face extended repair delays, particularly as vehicles age beyond initial coverage periods. Software and electronic support are increasingly critical. Modern vehicles rely on updates to maintain safety systems, infotainment functionality, and efficiency. A brand focused on controlling cash burn may deprioritize updates for older platforms. Over time, vehicles can feel outdated relative to competitors, reducing resale appeal and owner satisfaction. Depreciation risk is significant. Market confidence influences resale values as much as product quality. If buyers perceive dsautomobiles as uncertain or niche, used prices will reflect that skepticism. Higher depreciation raises total cost of ownership regardless of initial incentives. Dealer network stability affects daily ownership experience. Limited dealer density can mean longer travel distances and longer wait times for service. Remaining dealers may be overextended or reluctant to invest further. The premium ownership promise erodes when convenience and attention decline. There is also strategic uncertainty. If models are delayed, discontinued, or repositioned, owners may find themselves with vehicles that receive less focus over time. Even without abrupt withdrawal, prolonged ambiguity weakens confidence. Owners prefer brands with clear and durable commitments. None of this suggests that DS vehicles lack comfort or craftsmanship. Many offer distinctive interiors and a smooth driving experience. The issue is the durability of the ecosystem that supports them. Luxury ownership is as much about assurance as aesthetics. When that assurance weakens, emotional appeal fades quickly. From a forensic financial perspective, dsautomobiles represents elevated risk rather than immediate failure. Its challenges are structural and persistent. Consumers considering the brand should weigh design appeal against long-term uncertainty. In an industry defined by capital intensity, rapid technological change, and unforgiving economics, choosing a brand under sustained pressure carries consequences that extend far beyond the showroom. Please subscribe to our channel. We want to hit 1,000 subscribers this week.